Monetary policy enthusiasts are standing by for that 10 a.m. speech by Jay Powell. Remember, he's been not doing a great job on getting inflation back to target. It's been above 2% for 4 years in the United States. Let's get thoughts from Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Of course, we're all experts on monetary policy, and we all think we could do a better job than Jay Powell. I mean, America has a $30 trillion US economy, so much that he has to monitor. Have you any expectation of Powell making headlines today, saying anything surprising?
Well, Andrew, great to be with you. And absolutely, everybody is an armchair strategist on rates. And you mentioned 30 trillion economy. We have a debt load to match too, so not great news on that front. But to your point, in terms of today's meeting, he has an interesting. So it could. I don't expect fireworks, but he could say something meaningful. I mean, there's an interesting challenge going on right now. Certainly, inflation very, very, is high, and to your point, that has not come under control. And everything we see so far suggests that's going to continue because tariffs haven't taken full effect. They're still phasing in. But the other side is the labor market, and certainly we saw weak numbers, those revisions. We got to see how that continues. But the one thing that's really coming through in the labor market is there's very little hiring, but there's no firing. And other indicators say, wages are staying stable, but that's going to that will also now have equal consideration for them as to whether they'll have to worry about a weakening labor market. So they definitely have a fuller hand now, things to worry about at this point or other. And it'll be interesting. The markets are expecting 2 rate cuts this year. I'd say Powell will indicate today that, yes, September is going to be live, meaning that there'll be full consideration around what our next steps will be. But there is still information to come before that in terms of the payroll print and inflation print. So, markets are certainly going to be watching. I'll be glued as well in trying to parse through what he's saying there. And he may tilt, saying, hey, inflation is more the top risk, but it'll be interesting how we, I guess, addresses that central issue.
You may have touched on this, and I'm sorry, but you do say over the past year and a half, a lot of the hiring has been in healthcare, education, and government. Now, of course, they add social value. Ultimately, they add economic value, but they're not directly corporate producers of goods and services. I guess healthcare is on the borderline.
Right. But to your point, that's a consideration, is that the growth that we've actually hasn't been that broad-based in labor markets. So, again, we haven't seen layoffs, but that's one of those things that they have been looking at, and those areas certainly are slowing down. And but the view going forward is with the immigration dropping and all of that, that maybe the sustainable pace of job growth is more like 60,000 jobs rather than what we had before last year, which was like 120,000 seemed to be the one that was matching demand and supply. So we have a slowing economy as a result of that, but maybe the labor demand and keeping people employed maybe less of a challenge, just because fewer jobs, but also fewer people open for them. But again, a very dynamically shifting labor market, and that's actually the big topic of conversation. They always have a special topic, and this year it's labor market, demographics, productivity, and we'll see what comes out of that research. Again, they don't usually push a lot of comments on where they think that might be going, but it's an indicator that they're putting a lot more thought into, if you will, what's driving the labor market as we go forward here.
Any takeaway from earnings season? I mean, so far, corporate America dodging the tariff bullet, it seems.
No, absolutely. I mean, the takeaway, and that's a big piece of it. Corporate America had certainly gotten inventories loaded up, so they're riding that wave in terms of they have to pass it through. Companies on their earnings calls definitely sending the message, we're going to try to do absolutely everything, to avoid passing that on, see where that comes out. So I think that's going to continue, but the full effects have not been felt, and that's what the phase is going to be. One thing I thought was notable, like Walmart is always one of those indices like that everyone pays attention to, the same way you pay to JP Morgan on the banking side. They're so big, and the one thing that Walmart, and they missed earnings, it wasn't so much on their core business, it was other write-offs around it. So overall, pretty good quarter. But they were making the comment that across all income levels, they're seeing an uptick in sales. And why that matters is that they're basically saying that high income are also spending at Walmart. When that happens, it really means that consumers are shopping around for value, because those high income consumers are usually the least price conscious. The fact that Walmart's seeing them showing up more in their stores tells you something, that people are really stretching budgets, and that's why corporate America is in this point about, okay, how do we pass through tariffs if we need to do that, or well, we'll have to do it at some level. They're trying to thread the needle, saying we don't want to wreck our market share, so we've got to be careful. We have to communicate it correctly. We have to try and weave that in. So that dance is still continuing, and it will for the next several months as these tariffs become more and more entrenched.
Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management.